The Spin-off Podcast Network.
It's the ideal situation, getting paid to do what you love. In the new season of This Is Kiwi, Jane Yee talks to a new generation of Kiwi using the power of passion to unlock financial freedom. To find out more, tune in to This Is Kiwi every Monday, right here in the When the Facts Change feed, brought to you by KiwiBank in collaboration with the Spin-off Podcast Network. When the Facts Change is brought to you by the Spin-off Podcast Network, in partnership with KiwiBank, the bank for Kiwi looking to get ahead in business and in life. A bank that delivers expertise and banking know-how, smart advice for business owners wanting to invest, grow their business or diversify. A bank that adapts with technology through the lens of its people and customers. It is a bank with heart that is driven by its purpose. Kiwi making Kiwi better off. So I've been driving a car for 30 or 40 years. And like everyone, you look over the bonnet and you try and work out whether someone's going to hit you or not. And maybe you look into the rear vision mirror, and when you're about to turn left or right, you stop, you look around, and you push on the indicator, and you hope that everyone else sees the indicator light. And in many ways, thinking about managing the economy is a bit like driving a car. You've got a dashboard in front of you that tells you how fast you're going, how fast the engine's going, whether you're overheating or not. You've got brakes, you've got an accelerator. And in many ways, thinking about the Reserve Bank and monetary policy is a lot like thinking about someone who's driving a car. But it's not quite as easy as driving a car, because unlike when you're driving a car and you can see exactly what's in front of you, you know what you've just driven over, you know exactly how fast you're going, and there's not too much doubt about it. I'm going 53 kilometres an hour and I just went over a speed bump that I shouldn't have. But for the Reserve Bank, in a way, they have to navigate the way forward by looking in the rear vision mirror. And at the same time, move the indicator stalk left or right and tell everyone else in the economy where they're going. And sometimes the view is obscured through the rear vision mirror, and maybe the feel they have of how fast the car is going or whether it's about to break apart isn't quite there. It's not a Ferrari. It's not like you can tell from the seat of your pants how fast you're going and whether you're going to blow out the corner or not. This week on When the Facts Change, I speak to one of those drivers of the Reserve Bank of New Zealand. Paul Conway is the chief economist, and his job, in a way, is to hand over information about how fast the car is going, what the road ahead looks like, what the road behind actually looked like, and whether or not to move the indicator and jump on the brakes or jump on the accelerator. I spoke to Paul Conway a few days after the Reserve Bank decided to take its foot off the brake a little bit by cutting interest rates 25 basis points. Just a few weeks before, the Reserve Bank had looked out over the bonnet and said, it's unlikely we're going to be able to cut interest rates until well into next year. The view was obscured in the rear vision mirror. Now, there's a debate from around the Reserve Bank about whether they should have seen this earlier. One of the issues we talk about is whether the data that's coming through to the Reserve Bank is coming through fast enough. In particular, New Zealand is one of the few countries in the world still that does not have monthly inflation data or monthly unemployment and jobs data in the way that the rest of the world has. That's something that needs to be worked on. But the Reserve Bank did change its mind. You know, that old phrase, when the facts change, what do you do, sir? You change the mind. Well, the Reserve Bank has decided to change its mind and cut interest rates. The question now is how much they cut interest rates in the future and how fast. We talk about that as well with Paul, and then go into a little bit more detail about what's happening in the underlying economy. Why is it that New Zealand's productivity, the amount of output we do every hour, isn't growing that quickly? And what are these underlying features of the economy that are stopping us from growing? Now, it's not the Reserve Bank's job to change the underlying settings of the economy. They're not in the car building or the car rebuilding business. They're in the car driving business. But it is certainly something to think about as we head into the future, because remember that inflation in many ways is just a reflection of the car not being designed properly and overheating. And that's an issue for Paul Conway and everyone else to understand. We really don't have a well-designed car. It is grinding and it is overheating and it is spewing out smoke. And unfortunately, that tension, that steam that's being blown off is actually New Zealanders leaving to go and live in Australia. As we've seen this week, fresh figures showing that over 80,000 New Zealand citizens are left to live overseas permanently in the last year, more than doubling over the last 3 or 4 years, and a new record high. It's one of those escape valves in our economy. This week on When the Facts Change, we talk about how quick our economy is going, whether it's time to take the foot off the brake, really, and how the driver feels about that dashboard. Well, kia ora, and welcome to the Chief Economist at the Reserve Bank, Paul Conway. Great to see you, bearing a brand new monetary policy statement.
Kia ora, Bernard. Yeah, nice to see you too. And yep, absolutely. We put out an MPS last Wednesday. And, a different sort of part of the monetary policy cycle in that we eased the official cash rate by 25 basis points with more to come, which is gratifying, just given that it's a sure sign that we are increasingly confident that inflation is in the band close to that 2% target and likely to stay there into the future.
Yeah, I mean, there was a decision without a monetary policy statement 6 weeks or so ago, which talked about the need to just watch the data. And the previous set of forecasts that came out in May was still talking about, not being able to cut interest rates until next year sometime. So what was the change in that 3-month period that meant that you were not only talking about cutting but actually cutting?
Yeah. So May, that's exactly right. It was a different sort of time. The economy has moved quite significantly since then. It's not so much that we see that in the sort of marquee Stats NZ data, but the real difference between May and now, and even July and now, has been more in high-frequency economic data across a whole range of different areas in the economy. And normally that data, well, it is by nature quite volatile, but we're getting just a consistent signal across a whole range of high-frequency data that activity in the New Zealand economy has slowed. So that was sort of the big difference between May and now. In May we were worried about pricing behaviour staying elevated, so we were worried about persistence in inflation. So we flagged that actually as an upside risk, and we also flagged the possibility of greater economic weakness than we were anticipating, more as a medium-term risk in that May monetary policy statement. And as it happens, the first risk about price-setting behaviour has not come to pass, and we sort of say that based on measures of inflation expectations. Certainly in terms of business expectations, they have all returned to pretty close to the 2% target midpoint, so that gives us a bit of confidence that price-setting behaviour, wage-setting behaviour in New Zealand is once again becoming consistent with a low inflationary environment, which is wonderful. And then the second risk, that sort of medium-term downside risk to growth, it does seem to be more the case that we are in that world. And, we're not getting that from the GDP data. We picked our GDP data pretty much smack on for the first quarter. But in terms of the high-frequency data, it is pointing to significant economic weakness over the second quarter into June and the third quarter into September, the quarter that we're in now, which means less capacity pressures in the economy. And it gives us, again, confidence that domestically driven inflation, that so-called non-tradables inflation that we've talked about in the past, yes, it's coming down, but yes, it has been a bit stubborn and a bit persistent. But the fact that we've clearly got excess capacity in the New Zealand economy currently based on historical economic relationships, that gives us the confidence that that non-tradables inflation is going to continue declining in a way that's consistent with inflation getting back to the 2% midpoint of the target. And we've actually got a forecast for September quarter CPI is 2.3%, which is around that target midpoint. So a lot of change going on since May and now.
You mentioned the high-frequency data in your changed assessment on the economy. Could you talk about what sort of data you're monitoring and maybe how you're doing it differently to what you'd seen in the past?
New Zealand is not a well-measured economy. So data out of statistics, New Zealand, it's fundamentally important to what we do, but it is a bit lagged compared to other countries, and it's also prone to significant measurement uncertainty. So there are, there's components of that Q2 GDP, GDP number. Q1, I mean, there's just question marks around it. And even Stats New Zealand have sort of highlighted these issues. And the migration data is another example of data that's been typically highly revised as we move through time. So we are taking signal from all of that high frequency data. And it's stuff like card spending, PSI, the PMI, freight movements across the economy, the truckometer, even house sales, all that sort of stuff. We've actually got the technology where we're incorporating that data into our projections. So we're now casting GDP using that high frequency data. And I think, we have been doing that for a while. We probably haven't spoken about it as much as we should have, but it's certainly a difference between, the last time here, I was here at the Reserve Bank where it was more about those big sort of national accounts data coming out of Stats NZ. So I think having that high frequency data available to us is something that is perhaps a bit different from previous generations of central bank economists. And to the point now where we're clearly taking signal from that data. That was fundamental, that data, in terms of the decision to lower the official cash rate by 25 basis points.
Yeah, because the old way of talking about how central banks thought about inflation was that often they were looking in the rear vision mirror as they were driving ahead along the road, and there was a bit of guesswork in the operation of the driving steering wheel and the various levers and pedals. But what you're suggesting here is that you're moving away a bit from looking in the rear vision mirror to maybe having a bit more of a heads up display on your dashboard.
That's right. Given the nature of that national accounts data, there'll always be an aspect of looking back, just given that it is so lagged. But I think this focus on high, and I'm not saying we don't use that data. It's fundamental to what we do. It's just that high frequency data is allowing us to essentially forecast that, the kind of marquee data coming out of Stats NZ a bit better than what we have in the past. So still looking in the rear vision mirror, but, starting to sort of look forward. I mean, it's very difficult, to get data on what's going to happen next in the economy. But, there's ways and means and technology and, different sources of data, even private sector data. It's actually quite exciting what we can do in that space. The other thing I'll say is, the economy, it's volatile. We sort of pre-COVID, we came through what economists called the Great Moderation, where everything sort of sat around equilibrium. It was nice. And COVID disrupted that, and we are still working through. Those dynamics are still in the economy, and there's some good reasons to speculate that volatility or more volatility will be a theme going forward, things like geopolitics and climate change. So, we really need to sort of, even build our capability more to sort of have our finger on the pulse of where the economy is now, today, to set policy appropriately in a more volatile economy.
Some other central banks have devised Nowcast series, which everyone can see. They stick it up on a website. It's not quite a live streaming computer game, but it definitely is something people can look at day in, day out, and it does change day in, day out. And I think Massey University have also built some sort of Nowcast thing as well. Could the Reserve Bank, show us the Nowcast needle on their own website?
I think that's an interesting proposition that we should have a think about. It's sort of, when you think about the marquee Stats NZ data, there's like 5 or 6 big data outturns each quarter. And, that just feels, that's great. It's important, but it almost feels like a computer game, that someone would play in sort of year 11 business studies. We're across thousands of data series that give us richness into how those big macro aggregates are evolving. And I think, it could be useful for the RBNZ to publish on that more regularly. I don't want to get into the situation where we're commenting on data as it comes out, because financial markets need to understand our reaction function and sort of figure out what we're going to do ahead of us doing it, because they put huge bets on that kind of thing. And I don't think we can get around that. We can't sort of give a real-time indicator of where the economy is at day to day, week to week. But I think there probably is, we probably could go a little bit more in that direction than what we have been recently.
Yeah, it's not quite, the bear cam or the albatross cam where there's a live stream of, yourself and Adrian Orr staring at screens. So I think it's probably okay. When the Facts Change is brought to you in partnership with KiwiBank to help you understand the issues affecting the economy. And that's what their team of experts is here to do too. Here's KiwiBank's Chief Economist Jared Kerr with his prediction on what we can expect from the housing market and interest rates for 2024.
We've seen quite a correction in housing across the country. So house prices fell from the lofty levels that we saw in 2021. The Reserve Bank has pushed house prices down by design and by lifting interest rates to very eye-watering levels. I think the housing market has found a bottom, and I think we'll see house prices rising over 2024 and into 25-26. The housing market will be better balanced. We have seen a surge in migrants, which is adding demand to the housing market, and I think we'll see house prices naturally lift on the back of that surge in migration and hopefully an easing in interest rates later on.
Visit kiwibank.co.nz to stay up to date with detailed economic analysis and forecasts from Jared and other KiwiBank experts. They take big issues from both here and overseas and make them relevant to Kiwi businesses.
We started doing a pepeha.
I don't know where I'm from. Yeah, I'm gonna go check with the chef.
Takeout Kids, a coming-of-age documentary series, returns for Season 2. From a Thai restaurant to a dairy to a nail salon, 5 young people balance school and relationships while growing up in their families' shops.
Are you working tomorrow?
I go to school.
Watch Takeout Kids on the spin-off today, made with the support of New Zealand On Air.
Just on that big shift, I mean, I felt it at the time through June, July, where the economy sort of felt like it fell into a hole. Mm. What do you think was going on there? What suddenly caused that that slump? It was like a pothole.
It was, and we felt it too. It's interesting. We've got this thing, the vibes. We talk about the vibes of the economy, and and I think it's a legitimate sort of frame to use in terms of where the economy's at. Obviously, you get the vibes and then you see it coming in the high frequency data, and then it kind of works its way into those sort of bigger national accounts pieces of data. In terms of what drove it, and we talk about this in a box in the MPS, it could be monetary policy has kind of just the sort of effectiveness of monetary policy has kind of built up to a point where it sort of happened all at once. Of course, there's other things going on in the economy currently as well. Migration has declined very rapidly from an extremely sharp spike. So that could be part of the sort of decline in demand in the middle of the year as well, although migrants have an effect on the supply side as well through the labour market, or the fiscal sort of things that the government are doing. It could be that that's sort of hit home for many people. I mean, I know New Zealand, Wellington is sort of ground zero of that, and you certainly feel it in the streets here. So there are a few reasons to explain that pothole in a sort of growth outlook in the middle of this year.
Yeah, I've been following in particular the commentary and the surveys from the construction sector, several contractors, the EBOS survey of builders, the master builders survey, some of which are annual rather than quarterly, but they all note that there's been a significant drop-off in demand for what you call infrastructure, roads, pipes, homes, those sorts of things. Do you think people were a bit surprised by what's happened in that official horizontal infrastructure sector coming out of both government and local government from earlier this year?
Like, it is a very cyclical part of the economy, if not the most cyclical part of the economy for various reasons, the construction industry. You certainly see it in residential construction, and we're seeing that currently with building consents, dropping to very low levels. I think there is something in there around the change of government and some projects coming to a halt with the new government, and then there's a bit of a delay before the next government's projects get going. And I would imagine that's frustrating for the construction industry. I must say I'm in favour of and there is talk of it currently about more of a bipartisan approach to what needs to be done in the infrastructure space, and can we just sort of get on with that and roll it out as a program that goes beyond the political cycle. I suspect there's some good wisdom in that thought stream.
Yeah, I'm just looking at that fiscal policy area. You've put a box in the monetary policy statement this time around, in particular looking at the idea of the fiscal multiplier, which seems a bit old school, Keynes was always the guy who talked about the animal spirits and the idea that a government is not like a household, that often when it spends or stops spending, it can have a ripple effect through the economy. Could you talk about the fiscal multiplier discussion you've had here in the monetary policy statement?
Yeah, so it's like in big picture terms on the fiscal side, that we've got a government that is cutting government expenditure. So fiscal policy is disinflationary. It's coming back from the highs that government spending hit over the COVID period, which is helpful from a monetary policy perspective. So the idea of a fiscal multiplier, it essentially tells us, how is that going to show up in terms of, say, GDP or economic activity? And I think we've got about a 0.5 in there for that relationship. There's a lot of uncertainty around that. Different studies kind of put it at different levels, but that's sort of middle of the pack. And then on the other side, of course, what's happening with the fiscal is tax cuts from the end of July. So that's, we all, depending on where you are in the income distribution, but most New Zealanders do get a boost to their pay packets as a result of that. So there's multipliers there as well. How much of that is going to be spent and how much of that will show up in private consumption. And on net, when you look, like the sort of the monetary policy effects of that, is sort of what's the difference between those two big numbers, that reduction in government spending and that increase in private spending from a tax cut. And obviously, since May, that was the other thing about May, we had the budget coming the following week, which sort of added to the uncertainty for us in terms of, comms and all that at the time. But now, a few months down the track, we'll be learning about the sort of consumption effects of the tax cuts as they come through. We'll definitely be keeping an eye on that. But where we are at currently is that on a sort of net basis, those two numbers broadly even out from an inflation perspective, surrounded by uncertainty. But the Monetary Policy Committee is not too concerned about the effects of fiscal policy on inflation at the moment. Of course, the other thing that's changed is the economic context. When you do have inflation at, 4+% inflation expectations around the same level, then your ability to absorb an upside surprise to inflation, to the extent that the fiscal side of things, was an upside risk to inflation for us back then, that's less of a worry when we're forecasting inflation to be, 2.3% in the September quarter, et cetera, et cetera.
Do you have a sense on how much of the tax cuts might actually be saved rather than spent? Because a Treasury and then Revenue Department regulatory impact statement on the tax cuts estimated that 64% of the dollar value of the tax cuts would go to the top 40% of the income spectrum. So the suggestion is that there might be quite a bit of it saved by the people who get it. So do you have a sense there?
This is exactly the kind of things that we have been thinking about around the tax cuts. Like, where do they sort of hit the income distribution? And if it is more upper end, then the sort of marginal propensity, if you'll excuse the lingo, to spend out of that is going to be a bit lower than if they hit the sort of lower to middle end of the income distribution, because people there, they're more cash constrained So there's more chance that they will be spent, by lower income, middle income sort of people. So I can't recall the number that we're using in terms of how much of that will go through into spending. But yeah, that's exactly the right question to be asking.
And just though, looking now ahead, there is an element of relief. Interest rates, we're finally there. They're starting to fall. There's this idea that, maybe we're getting back to something like normal, although it's still very early days. But when you look at the underlying structure of the economy, not so much the short-term stuff, but, where are we with productivity, with investment, with real wage growth in the long run? I sense that in the last couple of years, Treasury and the Reserve Bank and all around the world, people are revisiting their assumptions about productivity growth, which, the old saying is there's only one thing that matters, it's productivity, and sort of downgrading their forecasts a bit for all sorts of reasons, albeit, things like COVID, climate change, technology, whatever. Is the New Zealand economy getting back to something like normal, or is it going to get back to a type of experience which maybe is a bit scarred? Maybe is it just a little bit slower, a bit creakier?
I don't think we are going back to normal. And I was saying that, writing about that all through COVID. Structural things have happened in the economy. And yes, there was a cycle on top of that as well, given sort of stimulatory fiscal and monetary policy and then the subsequent tightening in monetary policy. So we're not going back to normal. New Zealand's productivity performance has been especially disappointing since the pandemic for various reasons. It's not a long space of time. I think it's going to be another few years to a decade before we sort of fully get a handle on the impacts of the pandemic on productivity. But my sense of where we're heading back to now, and yes, it's wonderful. Inflation, from an inflation perspective, looks to be in the band, and we've kicked off an easing cycle. So, obviously very aware of how painful that's been for New Zealanders, but by the same token, pleased that we're getting through that disinflation period. In terms of the economy that we're returning to, or not returning to, but moving to, it's like in equilibrium, if you like. New Zealand is a low productivity growth, low wage economy, and I don't see anything to suggest that we're going back to something other than that. I know that the government, to its great credit, has aspirations in that space, which is wonderful, and exciting. It would be a big shift for the New Zealand economy to get to somewhere other than sort of, muddling along in an equilibrium sort of space. So, fingers crossed, we've got a structural change coming up there. No sign of it yet.
Paul Conway, the Chief Economist for the Reserve Bank, thank you very much for being with us.
Thank you, Bernard.
When the Facts Change was brought to you by the Spin-Off Podcast Network, together with KiwiBank. Visit kiwibank.co.nz to find out how KiwiBank are making Kiwi better off.
The Spin-Off Podcast Network.